Welcome back to another episode in the series, Discover the Future. My name is Lorel Scott. I am the co-founder and COO of StartupStarter and the host of 2022 Equity Crowdfunding Week. Etan Butler, chairman of Dalmore Group, and the co-founder and CEO of KingsCrowd, Chris Lustrino, and we are rocking. We are back. What's up, guys?
All good, brothers.
Yeah.
Nice to see your faces today.
So, Etan, you've been rocking with me for a long time. You're rocking with StartupStarter for a long time. You have believed in us for a long time. You've kind of propelled us to this place, and you're just a very known guy in the industry. People know who you are. People gravitate towards you. A lot of companies work with you. You're nominated this year at the Equity Crowdfunding Awards for multiple awards, which I'm really excited about. Can't wait to see who these winners are. We ran this for 3 months and had over 12,000 votes, so I'm really excited to dive into that. But more particularly around Dalmore Group and what you guys do and how you guys help companies. This particular series, everybody, is going to be talking about how the future of raising capital looks and democratizing the secondary market trading. Right. That's what you're all about, Aton. You're all about that. That's what Dalmore is all about. Tell me what that means to you guys. What does that mean for Dalmore?
For Dalmore, what it means is, there are 27 million plus companies in the US right now. All of them at one point are going to have a need for growth capital. And historically, it's been very challenging for companies to raise capital efficiently. And thanks to a lot of the hard work that many of the folks in the industry that I've a pleasure to know and work with, they spent that time in DC leading up to 2012 and really were instrumental in shaping out some of these exemptions that allow for companies to take more control of their own capital raising destiny, meaning the founders, issuers are no longer reliant on friends and family, which not everyone has, and there's oftentimes strings attached, or finding someone that believes in them for a startup. That's like an investment bank, which is really, really difficult,
Yeah.
or kind of launching a regulation D and only being able to appeal to very small percentage of the super rich. Today, through these new exemptions, an issuer is in the U.S. That's a U.S.-based issuer is able to take their structure, their valuation, what they're about, and offer that to the masses, to their own customers, followers, but also anyone beyond, pretty much in the world, in most countries. And that's a very powerful tool that is still relatively new as far as how it is in its current form. And it's experienced meteoric growth right through the pandemic, right through geopolitical events, because nothing's going to stop the entrepreneurial drive of the U.S. Nothing's going to stop the female or minority-owned founder that for the first time really has a tool that doesn't
Mhm.
make them reliant on someone else making a decision based on what they think. And that is very powerful. And with that comes a lot of responsibility and a lot of education. And where the industry today is pretty fascinating. And so anyway, that's a long-winded intro, but that's what it means to me.
Oh, good. I mean, I think it's good. I think that just adds more questions to this conversation because one of the things that I look at, right, we talk a lot about these companies that are actually coming and more companies raising equity crowdfunding, more companies raising equity crowdfunding. I think a lot of times the area that gets less focus is, the everyday person, right? Like, how do we get them more involved? How do we let them know that this is something that they can create generational wealth around? They can invest early into these companies, right? And have the opportunity to be like, wow, like I was an investor. And I think that sometimes a lot of different conversations that I hear, we miss that mark of it's very much about the startup and we need them to raise capital. But my mom also needs to understand that she can put $100 in this company or whatever that minimum is, you know.
Yeah.
So so how do you feel like between those two? Like we need to inform more of the startups. We need to inform more of the companies. We need to inform more of these companies who are eligible for Reg D. What are some of those steps we think we need to take to inform the people, right? Because we need the people.
So from the investor's perspective, you have to
Yeah.
be very careful.
Right.
Most companies fail,
Hmm.
and these offerings are conducted through marketing and promotion, and the investment minimums are very small. And so what's most important from the investor's perspective is to only invest what they could lose.
Hmm.
Now, they could, and there's laws surrounding how much a not yet accredited investor is able to invest in these different exemptions. So we need to approach it from a regulatory perspective to make sure that we're responsible, that certain folks that might not afford to lose so much for the first time being able to participate in all these things, it could be overwhelming. What do I do? This sounds great, this sounds great, but are they doing diligence? Do they really understand? They're generally not considered quote unquote sophisticated, although I hate the word. But
Hmm.
but that's how you have to treat investors in that way. So it needs to be done in a very compliant way. And at the same time, investors, yes, they do now have the opportunity at a very early stage in a company's development to invest in what might become the next big thing. In my
Hmm.
opinion, something like that is likely going to happen because so many companies are utilizing crowdfunding for at various stages of their growth. And we're seeing some examples of that with companies that have started off with a good old fashioned Reg CF, and now they're on a NASDAQ. A few of them. These
Yep.
are success stories. What people don't hear about are the failures because no one's going and advertising all their failures. And what's important to know that is this from an issuer's perspective, this isn't an easy thing to do and just set it up and it happens. I list on some platform and magic happens. It's a hustle. It's an actively managed process, and you need to be prepared to take that on. And you need to have the right expectations going into it and the right tools. And that's what we're really focused on. What's actually working, what's not. Put away the hype, and from a, from an issuer's perspective, that's where they need to kind of be going into it. But from an investor's perspective, there's all kinds of investments, right? There's first, it's important to understand what's out there, what your needs are. Like there's REITs, real estate investment trusts that are offering yield through Reg A to investors. That's a different type of a risk profile typically than a startup investment that might make it, might not. Um, but yes, you get to support your local businesses and people you want to be a part of. Yes, you get to diversify and build a portfolio like a VC. And these are very empowering things that I think people deserve. But it needs to be first and foremost, the risk component of this needs to be very clear because it's very easy to get swept up with what you might see on social media and in marketing.
I'd love to ask you. So, one of the things that I think is really cool about Dalmore is that you're a little bit different, right, from a traditional platform. And many people out there might not even know that you exist um, as Dalmore Group, and almost by design in a way. So, can you talk a little bit about what makes Dalmore Group different in the way that you support issuers and founders rather than a Republic or a WeFund or something like that?
Yeah, we're 18 years old. We've our roots are in investment banking and corporate advisory. We have Jobs Act 2012. We saw an opportunity to help companies raise capital online at scale, and then it went to not just accredited but not yet accredited, and we recognized that and kind of got into it from that perspective. I guess what differentiates us is our approach to our approach is what do you need a broker dealer for specifically? And how do we play that role in a super cost effective, efficient, and compliant way to empower you to raise capital for your offering? Different than register on my platform so that you could have access to see all these deals that are listed on my platform, including my own product, right? And get heavily marketed to with a bunch of different types of opportunities. Our issuers are building their own communities. And that's why we aim to be somewhat not as visible and somewhat behind the scenes. We power many platforms. We've signed on over 250 Reg A clients, including many of the more successful ones to date. We have signed on about 50 fractional share platforms that are building their own communities, and it's not about come register with Dalmore to then register with on this app. It's a direct experience, and so we pipe ourselves in from a compliance and regulatory perspective where we need to be to do our job in a very efficient way, and which oftentimes is the only step of the process that can't really be automated because it does require actual compliance involvement. But we try to do that in a way that feels like it's automated from a investor experience. So that differentiates us quite a bit. We're the BD on Reg A's, Reg D's, Reg CFs. We're the BD partner for other CF portals where we do broker-dealer work on many of the marketplace platforms that are out there and on some of their own offerings. So I guess we're pretty integrated in a lot of different ways. And now we're really focused on what's next.
And I just want to hit on one other thing because I think it's important for founders to know. I hear a lot from founders that they don't necessarily love spending tons of money marketing to a certain platform. And again, it's a choice. I mean, I don't think it's necessarily bad one way or the other. But in working with the Dalmore Group, something that I've learned in learning about you all is that you get to kind of control all of the data that you collect. You get to control all of the emails and the people that you bring to the portal through your own marketing spend and things like that, which is a nice level of control that you wouldn't necessarily get elsewhere. So just for those who are considering, that was another differentiator that I kind of learned about as we went through the process of evaluating the various platforms, which is pretty cool.
It's very cool and very much needed. This idea of having complete access to analytics so that you could tag pages and you could insert pixels, so you have full visibility where every investor is in the flow, in the funnel, and you could integrate the issuer could integrate their CRM to handle systematic ongoing communication that they could control, their marketing company could control. So that's really taking complete power of your own capital raise. It's something you could do for a Regulation A. And it's something you could do for other exemptions as well. But there's a lot of ways to win, right? And so not only is our model really, as I kind of described it, it's also focusing on what's working and what isn't for different offerings. And that kind of guidance in a way, or being a sounding board to a lot of the decisions that go into what are the tools I have? What could I use? From a technology perspective to a digital marketing, PR, and also to a syndication perspective, which you could do for Reg A and Reg D. Syndication, it's a new thing, but it exists, and there's a number of pretty successful examples of it that we've been able to help facilitate as the broker-dealer of record. So it's a strategy that you want to approach, starting with what's the right exemption to consider based on my circumstance. And then sometimes it might be a CF and a D before you do an A because of a variety of reasons. Or if secondary trading, immediate access to potential secondary trading is part of your strategy, then there's big benefits for Reg A because it affords that. So, it's really a discussion. Each issuer is somewhat different.
So, Etan, so when we look at these different regulations, right? What do you feel like is the path forward when it comes to the path forward when it comes to when I want to raise through equity crowdfunding? What is the big differentiator from raising through traditional means versus raising through regulation crowdfunding? So you mentioned those companies who are Reg A or they're Reg D, right? So why should I not go directly to a VC? I'm a well-funded company. Why should I go through a Reg D raise or equity crowdfunding raise at all if I can actually get funding?
Yeah, I mean, you should go if you have terms that work for you from an institutional investor, then why bother? Go on with it. Get on with it. You can market all you want, if you want to appeal to people and build a community, but why go through the burden and the time or even the expense that goes into launching a crowdfunding raise, unless it's part of your model. So I would say that absolutely, you certainly want to be talking to any types of institutional capital, but what we're seeing now, and perhaps it's more magnified because of what's gone on in the VC community over the last year or so, are some more sophisticated companies that aren't quite getting there with VC arrangements, with terms, with different components of the agreement that require them to take on a lot and give away a lot, covenants, and whereas in equity crowdfunding campaign, you're able to decide, this is the structure, this is my valuation, this is what I'm offering, take it or leave it, right? And that's pretty empowering, right? You want to be fair, you want to be priced appropriately. Platforms like KingsCrowd are bringing more transparency into the process. Investors, I hope, are getting more sophisticated, and I think that's going to continue. Platforms are getting more sophisticated, And more sophisticated issuers are now considering crowdfunding because they're seeing that it works well, and some of the increases have really woken up a lot of different folks in many parts of the industry. But I would say that you want to keep all your options open. It's not all or none, meaning you could have a Reg D and you could be knocking on institutional doors at the same time, provided it's disclosed and compliant, as you have a Reg CF that's going on. That's another door into your investment opportunity from anyone over 18. So you could combine some of these things and run parallel processes, investment banking processes and equity crowdfunding paths at the same time. And I think we're going to see a lot more of that.
Something that I'm curious about is on the fractional share platforms that you're helping to power, platforms like Rally Road. For folks who are investing, obviously there's a certain profile that comes with investing in startups. But things like real estate and collectibles, they kind of have a certain asset value, right? There's a little bit more protection there. So what are your thoughts, obviously not as investment advice, but what are your thoughts on kind of this ability to diversify across such a wide swath of alternative assets thanks to things like fractionalization of real estate and collectibles as well as startup investing?
I think it's the healthiest thing possible that could happen to any high-priced asset that remains trapped, oftentimes only trading once every few years, because very few people could afford $2 million on a painting. Therefore, for the industry, for the holder of the art, and for those who want to have exposure to that art, the healthiest thing to do is to fractionalize that into very low price shares, and add an element of potential liquidity to it through listing that asset on an ATS. And what that does is it brings more capital in to each of these industries that otherwise would never have a chance to buy a share of that Michael Jordan rookie or that single family home. And so it's extraordinary. Now, as far as the ability for an investor to invest across all these platforms, where do you start? There's a lot of different options. There's an element of investing, I think, that has a nostalgic component to it. People get joy in buying a $10 share of Wayne Gretzky's rookie. It's fun to have, and I'm not necessarily thinking about making money per se on it, but I kind of want to own it because he's always been my hero, right? So that there's an element of value that you have in that process alone, and then there's looking at things from an investment perspective. Like I've been tracking Wayne Gretzky's rookie, and now here's an opportunity for me to buy it. And this secondary, that's all going to evolve. This is still very new. The first fractional share clients were 2018 or so. Many more are going live now. And I think we're going to learn. I think ultimately where this could go is potentially like some market making components, some DTC eligibility, where the asset size is big enough for someone could hold a position in Schwab. I see this kind of ultimately bridging the gap to institutional investors, but for a small platform that's just getting started with either like sneakers or gems or athlete contracts, whatever it might be, it doesn't quite get the attention at that level from real institutional investment. But I think that's the potential of where this could go. Likely first in real estate and art, because they've evidenced, being able to assemble really big pools and large asset size that would justify this being an alt that was held in someone's portfolio. So I see this potential also in the IRA world, right? The key is getting this into a format where it's not just like buy a $5 share of a $10,000 card. It's buying into a larger asset size, and perhaps products that are developed from these different assets that are offered in that way as well. But from an investor's perspective, it's basically looking at what you would otherwise just in the ability to buy something for a few dollars per share. So if you're looking to build a portfolio of rental revenue, then there's a number of different places you might go to and download their app and explore that, and that's the path there.
So kind of like we talked through a lot really fast, right? Because these are short segments. Real quick, I'm kind of going to combine into. So where do you see, right, the industry going over the next 10 years? What do you think needs to happen for it to go mainstream, and to become one of the primary go-tos when it comes to raising capital, like for launching a new business in a XCF, or these companies who are looking for that liquid capital as well? What do you think needs to happen?
I think that what's going to happen is going to be a consolidation. You have many funding portals that are that didn't quite make it, where a few of them have been really dominant in the space. There's going to be a lot of M&A. For those who are fortunate, will be M&A. There'll also be people probably going out of business in that way, and some new people new participants that surface as well. I think that for this to be ultimately mainstream, I think it's heading in that direction already. And my assumption is that many companies out there of that 27 million or so might not even understand the full, like the alphabet of these exemptions, like CFD. Like, the reality is that when someone gets off of Kickstarter or Indiegogo and they start facing their equity needs, this should be a transitional tool that it has a lot of similarities in that way. But also, what's really going to drive this, and everyone's looking for, is predictability from an issuer's perspective. And if you rely solely on marketing, it's going to be a bumpy road and be more expensive than you think to get an adequate return on advertising spend, no matter which marketing company you work with. Secret sauce only lasts so long. The reality is, be prepared for a grind. And so you want to have other advantages. Advantages include those who have large ecosystems or access to a lot of eyeballs, right? Naturally. And that comes in a lot of forms, or effectively building a community over time that maintains that value to be used every time you launch a new asset or product to them. So I think that, you want to understand how to win before you start, or you want to be really level-headed going into it with the understanding that there's an element of unpredictability, and you want to be properly budgeted for that. So, it's really observing what's working well, what isn't. How do we try to bring the right productive participants in this industry together to work towards a predictable path as possible, and something that is very difficult to be predictable for every issuer.
Yeah, man, it's great. I love how detailed you are with your understanding of the question, but also how to make it simpler as well. So it's your second year. You are the guy who comes in and says, "Boom, what are we doing to lead the charge on Equity Crowdfunding Week this year?" Right? So you rock with us. So what is most exciting that you're most excited about this year about Equity Crowdfunding Week, attending the conference? Like, what do you want to hope to accomplish or see at the conference?
Well, first, it was because of your hustle and your drive that I saw, and also the creativity that I see you guys deliver. And so, that was a good horse to put to bet on, and to put focus on. I'm really thrilled with kind of where you guys have taken it this year. I think that you're able to bring in a lot of really interesting participants, and the event looks super exciting. So I've become more of a shut-in, as busy as I've been over the last number of years. So I haven't minded COVID too much. So I guess I could say I'm looking forward to the opportunity to be amongst industry friends that we all work together and do business with, and the opportunity to share my perspective of what I do and live and breathe every day, 6 days a week, other than Sabbath, where I'm totally immersed in. And it's fascinating. The opportunity to be with all these entrepreneurs, from the average American entrepreneur to the celebrity and the NFL athlete that are our clients. It's a real fun industry to be involved in, and it is expanding pretty rapidly as far as regulation, innovation, technology. So it creates a really interesting opportunity for those of us who are kind of early in at the foundational level of the industry, because it's evolving very fast, and it's always great to work together with others like Chris and KingsCrowd. Really appreciate what they've been doing, and what they bring to this industry is really revolutionary.
Listen, you've been a great mentor. We've never met in person. You've been a great mentor. I don't know if we went a week this year without talking. And you've you've been giving me great guidance, and I'm very appreciative of all the support that you give myself and to StartupStarter to really make this change for the community. Thanks,
You got
Etan.
it, guys.
Thank you everybody for listening, and we'll be back with more.